Hello, and welcome to episode 3 of Investment Banking Secrets. This episode is quite close to my heart. I remember when I started in investment banking, I was just bombarded with so much information and with such tight deadlines, and I was given certain tasks to do. And I just felt so overwhelmed and just going through the motions year after year after year, not really understanding where I fitted into the bigger picture. But it was only after a few years that I then saw what place I had on the team and what influence I had on the overall deal, getting the deal across the line, and how I saw I would interact with my fellow colleagues and how everybody would pull together to bring the deal together from an eagle's eye view. So with that comes a greater sense of purpose and a greater sense of belonging to the overall bigger picture. And I think that's very important, especially for a junior investment banker to understand. And today I'll just go through various roles that go into an investment banking transaction, typical of the debt side. So this could be either if you're on the lending side of an investment bank or if you're on the principal investment side, where you are giving a firm capital and in return you want some sort of interest or dividend or capital appreciation, and you'll either receive your capital back or you'll get an exit, some sort of an exit. So let's dive right in. So we'll look at a few things today. We'll look at the sales role. This is to do with business origination. Those are the type of people that are concerned with winning business for the bank, generating revenue directly. Okay. Then the structuring role. Now, these are people that work very closely with the people who are involved in generating revenue for the bank, because they actually have to deliver on the promises. They actually have to deliver to the client, and in return, the client will pay either interest, margin, fees, or dividends. So these people work very closely to the sales team. In certain instances, they can also be members of the sales team. The next role is the credit analysis role. Now, this is once the deal gets agreed to between the client and the provider of capital, there needs to be a certain amount of negotiation that goes into the deal. But once that gets bedded down, you need to then assess the risk of the transaction. So this is important because a bank, for instance, can't promise the client the moon and the stars, but then only to pitch the deal internally to the investment committee or the credit committee or the board. And the board says, no, that's too risky for our mandate. For instance, banks don't generally invest in equity. Okay? You do get some banks that have private equity divisions, but it's usually structured such that they take a controlling stake or very influential stake, and they have a high degree of influence over the company, and that's controlled and potentially comes off a different balance sheet. Now, if a bank is a traditional investment bank, they typically don't do that because equity risk is too high risk, and they've got the deposits of pensioners and your average man and woman on the street, and they don't want to risk investing in highly volatile, highly risky investments that loses them money, and then at the end of the day, the depositors suffer. So banks do have a mandate regarding the type of risks that they are willing to entertain. And it's the credit analyst's job to make sure that the deals that the deal makers bring, or the people who are involved with the revenue generation, the deals that they bring to the bank fall within that mandate. And we'll see how that works. The next thing we'll see are what capital and credit charges are. Okay, so this is still a credit role, but they're called central credit analysts. So it's balance sheet management or asset liability management or central credit. Those are some of the names that these roles are referred to. And basically what that is ensuring that when a bank lends money, they can lend money to potential clients in the most efficient manner. Okay, and we'll see what their jobs are. And then the last thing that we'll look at is it says deal monitoring and execution, the facility agent role. I'll just touch on that briefly, what a facility agent does. But I think the major thing there would also be unrelated to the facility agent role would be the syndication and distribution. And it goes hand in hand with the balance sheet management. So I think I'll spend a lot more time on that than actually discussing the facility agent role. But let's dive straight in. The sales role, business origination. Okay. Business origination refers to the process of winning revenue for the organization. Okay. These roles are often referred to as front office roles. So your front office roles are those roles that are occupied by people who are directly client facing. So they're interacting with existing clients and potential clients, future clients, in order to gauge whether or not there's an opportunity for your organization to add value to that potential client. And when your organization adds value, they can charge for it. And so these jobs are primarily involved in winning revenue, winning fee revenue for your organization. Okay, and we call them front office roles. So typical job titles that you would encounter if you want to have a front office role, you would apply to be a relationship manager, a business development director, or what certain banks deem to be client coverage. So those are what these roles are typically called in the marketplace. Your job skills, okay, this is quite important. If you're somebody who's quite knowledgeable about, but from a generalist standpoint, like you understand the key product offerings of your organization. You're not necessarily a product expert, but you know what a cross-currency basis swap is. You know what amortizing facility is, what a revolving credit facility is. And you know how all of these things suit different client profiles and solve different problems. So you're a bit of a generalist. You know a little bit about everything, such that when you're having a conversation with a potential client and you ask them, well, congratulations on your most up-to-date set of results. I see that you did suffer a loss on your on one wing of your business because you didn't hedge your currency exposure, and whatever exposure that you were exposed to ran out of your favor. Have you considered hedging? Okay, so you know a little bit about hedging. Or the bank says to a potential client, we understand that you have operations in numerous jurisdictions. Well done on your expansion strategy. How are you banking those different jurisdictions? Do you have a multi-currency account? Just pardon me, there's a storm happening in the background, so you'll hear the thunder from time to time. Have you got a cross-currency account, an account that allows you to receive and make payments in various different currencies? So although the salesperson is not necessarily a product expert, they do understand the mechanics of how those different products that their organization offers can solve various problems for a client. And they can talk to those products on a very general level, but they still know enough to say that, okay, what we can do is we can provide you with a presentation where we can invite some specialists from this division of our bank that can go into more detail as to how this product can actually benefit your organization tremendously. Okay, so in order to have that level of conversation, you need to be somewhat of a generalist. You need to understand the key product offering of your organization. The next is the ability to communicate complex business and product ideas in a very practical and easy to understand manner. Okay, so because oftentimes when you're working in a bank, you get confronted with a lot of acronyms and a lot of abbreviations and a lot of jargon. That's not necessarily going to win you the business. What wins you business is if you can communicate the benefits of your product effectively to a client who has a problem. So this takes a lot of understanding of what the product does, and it takes key communication skills, because you would probably have to describe a product in very general terms to somebody who maybe is not really au fait with financial mathematics if you're talking about hedging certain volatilities in the client's revenue line. So you wouldn't dive right into the technical aspects of that, but you would give a generalist overview of this is a hedging product and this is what it does to secure your revenue line or protect your cost line. So you see very general terms that communicate the benefits to the client. If you want more stability in your earnings or more predictability in your costs, then you would hedge in this way. Okay. So the ability to communicate complex business and product ideas in very practical, easy to understand terms. Important here is to be able to communicate benefits to a client. Very important. The ability to connect people, to be outgoing, and to be personable. Okay, this is quite important because as a generalist, you're not the one that is going to necessarily craft the solution from beginning point to end point for the client. What you then need to do is you need to identify what the potential opportunity is, but you need to bring people together. So you have got product specialists in your organization, people who are dealing with trading, people who are dealing with working capital management. And then your job would be to assemble the right team to pitch to the client. So you need to know who works in your organization and who the key people are to touch. So if it's a working capital presentation, you know, oh, I know 3 people in the working capital division, and this person is actually very good in this industry. I think let me communicate with this person and ask this person to run with this aspect of the presentation. The presentation could also have a hedging angle. I know to contact this other person. So the ability to connect people together, and as well to be very extrovert, very outgoing, because you are going to sometimes approach businesses cold. So you need to be able to strike up conversation, and you need to be very personable. In other words, people enjoy speaking with you. And so that's a skill all on its own, and we'll dive a bit deeper into that as we go along. So how do these people win business? How do they actually do it? Okay. How it works is you would have, if you work for a bank, you would have certain events that you would be a part of on a regular basis. So the bank could host art fairs, the bank could host golf days, charity events, etc., etc. The bank could also host industry-wide gatherings where like-minded individuals congregate. So what your relationship manager or business development director would do is they would have a phone book or Rolodex filled with contacts from various industries. And they would then say, okay, our bank is hosting a trade expo next month, and send out various invitations on their contact list. If they don't have the contact list, they'd have to build that. So they'd have to literally cold call organizations and say, I'm from such and such a bank. We are hosting this event, and I wonder if you could put me in touch with your financial director so that we could send him or her an invitation to this event. So you build up a list of contacts, and then you host these events, and then you would then open up that event to networking. You'd make sure that if it is your event that you have a complete brand building exercise. So you have your logo everywhere, such that when people come into the event, they know that it's a whatever bank you work for, whatever hedge fund you work for, it is your event. And then you'd go about networking with key individuals that you have invited, and you just set your business development directors or your relationship managers into the crowd and let them do the networking and the probing for opportunity. And you need to do it very intelligently, because if the event is not directly business related, it's not a direct networking event, let's say it's an art event, you need to do it very subtly, such that it does still allow you to probe for opportunity, but it's not directly in your face. We want business today. It's more of, we're here anyway, let's discuss certain things. And we'll see how that works a little bit later. So again, networking with high-profile individuals at expos and trade events, hosting charity and other seemingly non-business related events to boost company and brand image. Always being top of mind of your client, okay, remembering birthdays, anniversaries, etc., etc. This is quite important, especially if you have got an existing client. It's always good to be top of their mind. So if they have a birthday, you would send them a birthday gift, maybe a bottle of wine, birthday card, etc., etc., just so that the client is always top of mind. Strategically suggesting value adds to the client, free economic briefings. low value or loss leading products to gain the client's trust, and then handing over to more specialist members of the company to upsell. Okay, so let's see how this is done in practice. So in my course, you can sign up for this course for free. I do have a course on Udemy. You can just visit my Udemy page. I'll leave a link below, or you can visit my website and get a link to this course, where I run through a typical pitch or investment banking presentation. And this is just fictitious, but it's one where we have identified that this client needs a hedging solution. And what we do is just fictitiously pretend that we were at a networking event, and then the relationship manager opened up the conversation. Obviously, you need to be very informed with what's happening with a client and in the market. So then you'd open up the conversation. Hey, congratulations on your previous set of results. We noticed X, Y, Z. And we've got across our portfolio, we noticed that people in your industry are looking more and more at crude oil hedging. Is it something that you've considered? And then you get the prospective client to talk and to communicate what they are struggling with and what they're really doing well. And the more you get them to talk and the more pointed questions you ask, the better you'll be able to uncover opportunities. So that's a bit of a cold approach. But if the client is existing in your book, then a good idea would be for you to do periodic economic forecasts and economic updates. And you could say that we would provide these for free. Every 3 months, we would come to your organization and give you what we believe the forecast is for the next 6 months. And companies really do appreciate this, because they don't have the extent of budget for research that your organization probably has. And they would appreciate as much intel as possible. So you give them this free product or this loss leader, and it can be a free hedging solution or a free personal account, working capital account. You could do the payroll for them. So it's just to get them used to your bank and to get them to trust your organization. And as we see in this presentation, we would give the client a free economic outlook of what's going to happen in the short term, the medium term, and we would do this for free for the client. Okay. Going back to the other presentation. Okay. You always need to be top of mind. Okay, that's where we stopped off. Strategically suggest value adds to the client. Okay, free economic briefings, low value or loss leading products, as we discussed. Okay, and then upsell. If you've already captured the client and you're already doing business with a client, you are still always in a communication loop with this client. And this allows you to, on an ongoing basis, again, do an economic briefing, probe for opportunity. How are our existing products working for you? How could they be better? Maybe instead of having just your payroll with us, why don't you do your cross-currency transactions with us as well? And maybe we can look at a pricing benefit because you already have working capital facilities. Maybe we can give you a pricing benefit there. So it's always upselling. What upselling is you're already providing value to a client, but you're looking at how to solve different products in maybe different areas of the client's business. And the more problems you solve, the more intertwined you become with a client and the more value you can add to the client. So the more value you add to the client, generally speaking, the more revenue that you can make from a client. So you start off from a low product and then you sell the existing client more and more services. So that's what upselling is. How do you excel at this job? So I myself, I was in a front office role, but I was more on the deal making side. So we worked very closely with the sales roles, people who were in the sales role, but we ourselves also used to network and pitch for new business all the time. So what I saw working with my mentors and people who did very well at the job is they knew their clients and potential clients very well. You know your clients and your potential clients inside out. You read their market updates, you attend their press briefings, you analyze their financial performance, any changes in management, etc. You almost do it as a hobby. There's no deal on the short-term horizon, but you're just checking. To keep you interested as an investment banker, if you can do this, there are a lot of rules with insider trading that you need to be careful of. But if you just invest in an index and you see which clients, like a mining index, and hopefully some of your clients are in that index, what I found will keep you interested as a junior banker is if you put money as well. So you can invest in an index, doesn't have to be a lot of money. And then you can see which companies are pulling the index up and which companies are pulling the index down, and understand why certain companies are doing well and certain companies are doing badly. I find this is a very nice way to keep you engaged when you're an early analyst and maybe you don't really see the significance of your role, but it helps you to always keep abreast of your clients and keep abreast of what they're doing on a daily basis, and as much general knowledge as you can get by always keeping abreast. Doing a little bit a day is much better than devoting 1 month to reading 100 financial statements. Not that you'll even have the time to do that, but just keep it on your news feed, your key clients, and there'll be a story every month for one of your clients, and you just read their announcements and just keep abreast of what their performance is. Any changes in management, you would typically be dealing with a head of treasury if you're providing a debt solution or a treasury solution. And if they resign and are replaced by somebody, you need to know this. And the only way you'd know is if you're always in the client's face. So it's always about maintaining those relationships. It's very important. It also makes them a lot more sympathetic to hear your points of view, and it makes them a lot more sympathetic to accept meeting requests from you if you are quite close to them and you are always in good communication and good standing with the client. Okay. Keep abreast of current events in the industry, in the economy, and in politics, etc. I mean, general knowledge is a very good thing to have. It's always good to follow certain podcasts that are quite general as well, that just give a general macroeconomic overview of what's happening in the economy and in the world in general. And from there, I mean, my advice to you is choose somebody seasoned and quite generalist, and they will feature other people on their podcast. My personal favorite, guys like Doug Casey and Rick Rule. Those are some good people to listen to if you're in the mining sector. And you just follow them, and then they will be featured on other people's podcasts, and they will also feature other people on their podcasts. And then you'll kind of just grow a wide range of podcasts to listen to in order to get a certain type of information. So that's my advice to you as well. This will help you to be able to ask intelligent and informed questions that encourage discussion and open the door to probe for opportunity. You want to make sure that your questions are intelligent. It's not a good thing to make an event, a networking event, like an interrogation. So you're asking the client very pointed questions that are unresearched. What have your profitability margins done this quarter? Why did they do that? It's like almost a press briefing. And in the client's eyes, you're not really adding value. It's becoming like an interrogation. But if you come to the conversation or the interaction with some knowledge and with a little bite-sized bit of information that the client finds interesting, a conversation starter. Did you know that the US Fed is forecasted to do ... How are you guys responding if that actually does happen? Or across our portfolio, we've noticed that a lot of our clients are preparing for a market ... It's interesting to know, do you agree with that consensus, or are you going the opposite way? Those are intelligent questions, and they're more informed, and you'd get like a different response from a key potential client if you ask a very intelligent question. We actually didn't think of it. It's very interesting that people in our competitors or people in our sector are actually adopting this approach. We thought about it in the other way, but I'd actually like to hear what the bank's thoughts are on that. And then you could very easily, then the door is open to say, well, what we could do actually is we could, let's contact your your office to schedule maybe a 2-hour economic briefing where we could go through this in more detail and just unpack our thinking as to where we think this is going to go in the future and how it will impact your firm. Done. Very good. You've instantly built a bit of rapport, and you've shown that you are adding value, so they will more likely accept that meeting request and invite relevant people to that meeting where you'll present your ideas. And it's a very good thing to build rapport and to probe for additional opportunity in that meeting. Now that you've already added value, shared your insight, they feel relaxed, they feel comfortable. Wow, these guys know what they're doing. You know what, actually, we didn't mention it at the charity event, but we are actually looking at what you mentioned to us, but we don't know how to implement it. And then you can then suggest a follow-up meeting with a product specialist in that area that can help explain the process, and you would be the service provider of choice. And that's basically how you win business. So this goes to the next point. Be patient and positive. Some potential clients take time and persistence to pay off. Yeah, I mean, we've had, especially in the mining space, which is where I was working in for a few years, we had clients that were prospective clients from the time I started until the time I left, and no deal came out of it. I've looked at projects for 5 years that never got off the ground, and this is entertaining the clients, taking them to lunches, always keeping abreast of how they're doing and what they're thinking. And yeah, I mean, sometimes it takes years. You just have to be patient and be positive and actually enjoy the interaction to a certain degree, enjoy it regardless of outcome. And the first tip I gave you is invest in an index. This is a good piece of advice. If your money's on the line, and it doesn't need to be a lot of money, it can be just the minimum investment requirement on that index. So you're not doing it for profit reasons. You're doing it just to be a bit more engaged. So this helps a lot. And especially in the long run, building the networks in an organization, solving the problems, putting together these presentations, which you probably will have to do as a junior, and just putting your hand up. Don't be too afraid to ask questions and to make comments in these sales presentations and to show that you are engaging. And that just boils down to confidence. If you are in a front office role and you are a junior, try to read up and ask at least one question in every meeting. Say to yourself, I'm going to ask one question. And you'll be lucky if you're in an organization that welcomes that. But just say, I'm going to ask one question, at least one question in this meeting, and make sure it's a good one. So you need to read up and know about that client before the meeting. Just read up on their latest trading update, and you'll think of one question. So that's very good for you to do. Next, have strong networks within your organization and within your client's organization. Having strong internal networks will help you always know about new product offerings, okay? And having strong network within your client's organization will help you identify key individuals. So this is important, networking. Network internally. It's important for you to have good relationships with your teammates and your colleagues, and also people who work in different divisions. So attend team events. This is good, even if you're not necessarily passionate about your current job role and what you do. If you are in front office, the main thing you should remember is, there's that old cliche, your net worth is your network, or vice versa. Your network is your net worth. So just being cordial and being friendly, helping people out, karma really does play out, but it's a long-term play. Helping people in your organization as much as possible, just being open to help people and not ask for anything in return, just adopting that servant attitude, especially at the beginning of your career. And then as well as you develop in your career as well, always helping the younger ones come up, being generous with your time, because they're not going to stay juniors forever. I mean, it takes about 3 or 4 years and they will be actively doing business of their own. And those will be your contacts, and they will think of you favorably because you help them come up, and help them to come up as quickly as possible. So that builds very good internal networks within your organization, such that if there is a potential transaction, you're going to be top of mind. Okay, bear that in mind. So somebody in the real estate space was at a golf day and networked with the chief financial officer of a mining company, thought there would be an interesting contact for you to get in contact with. They might be doing some M&A deals in the future. They'll pass that contact on to you before they pass it on to anybody else, because of something that perhaps you did 4 years ago. You helped that somebody in the real estate space tremendously 4 years ago. And you've forgotten about it, but it does come back to help you in 4 years' time. So having strong internal networks is always good. The next thing is external networks. So with your clients as well, always endeavor to add as much value as possible to your clients. That should be the end goal. Your clients should always feel a sense that they've gotten more value add than what they have paid for. And this is very important if you are in a sales or front office role. Another cliche, the fortune is in the follow-up. So even after you've closed a deal, just follow up. Is everything going okay? What can we do better? And maybe there's an opportunity to up your game and improve from time to time, or also upsell. Okay, now we look at, this is the role that I occupied. I was a deal maker, and this is more the structuring role. So after a sales pitch meeting has been set up, sales personnel would invite deal makers and product specialists to present their ideas to the client to try to solve the client's problems and win business for the organization. So deal makers are also front office and are also sales focused. So you are interested in winning revenue for your organization. However, you're also a product specialist. So a deal making role is quite a multidisciplinary role. Some of my job functions, you need to sell the deal externally. You need to present the benefits to the client. You also need to structure the deal so that it solves the client problem. Now, this can be an iterative process. At the same time, you have to make sure that the solution that you propose to the client conforms to your organization's internal risk frameworks. So make sure that you don't promise the moon and the stars, and you forget completely that you actually have to get this deal through your credit committee, who's going to say, you know what, this falls out of our risk mandate. It's a little bit too client friendly. You need to bear in mind that we also have depositors as our stakeholders here. So this risk is too risky for us. Even though it solves the client's problem 100%, it's out of our risk mandate. So you need to structure a deal. Basically, what structuring is you are putting the deal together such that it solves the client's problem, but you're also looking at all the ways that, all the risks that that deal opens up to your organization and how you can reduce or eliminate those risks. Helping with the financial modeling, this is very important. So the financial modeling often drives the structuring of the deal. You can't propose a structure that the client's balance sheet can't take. Whether it's a debt solution, you look at the model to determine whether or not there's debt capacity. And that's something we cover extensively in our financial modeling courses and in our mining finance course. Looking at a model and determining whether or not the client can take a certain amount of debt, and whether that debt is senior debt, subordinated debt, or whether the client just needs equity. So doing that assessment of debt is something that you need to be very good at. So that's Excel modeling. And also unpacking financial statements, historical financial statements. So you are helping the credit analyst piece together all of the information. And this is actually very important for you to see if the deal is actually feasible. And once you believe that the deal is feasible, then you would present it to your credit committee, and your credit committee would approve, and then you'd go to the client and say, we have credit approval if it's a lending transaction, or if it's something like a principal investments transaction where you have some equity upside, you'd go to an investment committee, and the board would say, yes, we approve this investment. Private equity, pretty similar. and you'd write your investment or your credit paper accordingly. And then you'd need to, after that, start implementing the deal. So the deal itself is expressed in something that's called a term sheet. I'll just put an example of a term sheet up here. So a term sheet just shows the key features of a transaction. This is taken from the mining finance course. You have whoever your borrower is, the company, what facilities they would be borrowing. In the context of this example, the firm had these facilities in place, but now they are refinancing or replacing this first facility with a new facility. And you show what the debt consists of. It's an amortizing facility and a revolving credit facility. You show how the banks would be split in terms of Taro Bank would lend $500 million, Trust Bank and Major Bank. So you'd share the facilities equally among the three banks. The tenor, the repayment schedule, interest rates, upfront fees, is there any hedging in the transaction? Basically what your term sheet is, it's an abbreviation of all the key features of the transaction that you agree between yourself and the client. So they sign and it's a legally binding document. However, it is very light. It's very summarized. After you have got credit approval, one of two things can happen. Either your credit committee or your investment board okays the deal as is. So they're like, okay, you structured a very good deal. We liked your permitted distribution regime that the company can only distribute up to 50% of net profit after tax. We like all of that, and we believe that you structured the deal 100%, full marks. You can proceed as before. That seldom ever happens. What usually happens instead is your credit committee will say, okay, we've had a look at your financial covenants. We think that this risk is too much. So whereas before you've got your debt service cover ratio, now you don't have a debt service cover ratio. We want you to insert a debt service cover ratio into the deal. Otherwise, we can't approve the deal. It's just too risky, the deal that you propose and agreed to with a client. Now, when this happens, it's up to the deal maker to do damage control. Because you have already agreed this deal with the client, but your credit committee does not believe that the risk is commensurate with the return. So you have to go back to the client who is happy, and you have to say to the client, you know, about that deal that we agreed to, we kind of have to change a few terms and conditions on that deal. Now, this can be very painful, and a good deal maker would generally come up with a solution that is win-win. So you can say, well, instead of a debt service cover ratio, could we perhaps introduce a covenant to the client that their 6-month forward-looking liquidity needs to be above a certain level? Okay, so it's a go-between. So the client does not want the debt service cover ratio, and the credit committee does, but you will somehow you'll propose a middle ground, and you'd broker that with the credit committee. They'd say, okay, fine, that's a good enough compromise. And then you'd broker it with a client, and your client would say, you know what, I'm not happy, but okay, fine, it's a compromise on my part. And then basically what the deal maker is a go-between, in between the bank or the internal credit committee and the client, and they try and make it work. They try and bring both potentially conflicting interests together. Okay. So after the credit approval, you then need to drive the legal negotiation and implementation of the deal. So you're basically putting that term sheet into full legal documents. So the term sheet is quite light. I mean, I've seldom seen, I have seen in one instance, but that was a well-established corporate. That corporate was a price maker in the market because everybody wanted that corporate's attention and wanted their business. So that corporate could pretty much print out a 50-page term sheet and say, this is the term sheet, take it or leave it, because they were in a very strong negotiating position. Those are the anomalies. Generally speaking, you have clients that don't have that much negotiating power, and your term sheets tend to be a lot more broad and a lot more loosely worded. And the legal documents tend to be 100 pages long because they just tie up all the loose ends and all the vague bits that were in your term sheet, and they put it into concrete language such that there's no potential for any misunderstanding. So your typical term sheet can be between 10 and 20 pages long, and your legal agreements between 100, 150 pages for your common term schedule, depending on the complexity of the deal. If it's a project financing, it's anybody's guess. You know, it could be a thick stack of common term schedules and individual legal agreements that link to the common term schedule, and you could have a whole myriad of legal agreements. So Dealmakers instrumental in ensuring that the legal agreements capture what was in the term sheet. And the devil is often in the details. So if something was vaguely worded, going back to our term sheet example, permitted distributions, for example, no more than 50% of net profit after tax to be paid in aggregate for dividends. Okay, that sounds pretty clear. But how do you calculate net profit after tax? Okay, this needs to be step by step, methodically ironed out in the legal agreements. And what you'd find is then this is the contentious point. They were happy with 50% of this number, but how do you actually calculate the number? Do you omit, I don't know, do you omit any deferred tax liabilities, or do you include them, or I don't know, a whole host of things that can be contentious. So the deal makers driving that process, sitting with the lawyers, the client's lawyers and the bank's lawyers, and you are negotiating. So the deal maker is important. The negotiation can't happen just between the law firms. The deal maker needs to be there to understand, okay, what are the things that we can give and what are the things that we take? What issues make the transaction break down? And what issues, okay, the transaction still works if we capitulate on this point. It still works. Like you as a deal maker, you're thinking about the commercial aspects of it. What is market standard? Okay, maybe we asked for a debt service cover ratio to be included and calculated on this basis, but actually in the market, if we look, your debt service cover ratio is not calculated like this. It's not a market standard approach. So maybe we can capitulate on this one and give this negotiating point to the client because it's market related, you know. So it's very important for the deal maker to drive the legal process as well. The next point there is finding the most efficient way to deliver the deal internally from a capital point of view. Okay. Now this is where you get a very good deal maker. The devil is always in the details. So the client is happy they're going to get their $1 billion facility and they're going to get it at a margin of 4% over LIBOR. Everybody's happy. How do you source that $1 billion? If your bank has, for example, numerous balance sheets in numerous jurisdictions, what I found in my previous role is that depending on the type of transaction, what you could do is you could lend from a certain balance sheet in a certain jurisdiction, and that would decrease your credit and capital charges. Maybe you're doing a dollar loan. Maybe if you do the dollar loan from South Africa, it's going to be expensive. But if you do the dollar loan from a different jurisdiction, the dollar loan, in terms of raising that loan, which we'll touch on a little bit later, your costs of raising those dollars decreases. So a good deal maker would have that intel. It's not necessarily within your direct job role to look at your asset and liability management or central credit, but because maybe you've got a friend in central credit and you discuss these over lunch, your friend tells you, hey, did you know that dollars are 50% cheaper off this balance sheet than off the other balance sheet? Stored. You store that piece of intel, and a little piece of intel like that, when you're writing a deal, the client is not even bothered, but internally you know that for your division, you've just boosted your profits by 50%. And it's those little nuances, those little things that make big differences. So, job skills. The ability to understand the key product offerings of your organization, very important. The ability to communicate complex business and product ideas in very practical, easy to understand terms, very important. The ability to connect people, okay, to be outgoing and personable. So all of these things are more or less in sync with what a sales role entails. Maybe the first point, you have to be a little bit more, you're the be all and end all of the product. You need to know every single thing about the product, whereas somebody who's in a dedicated sales role can be a bit more generalist. You need to understand the nitty-gritty about how this hedge actually works, how you can roll it forward. What if you don't want to deliver into the hedge? What are your potential options? Physical delivery, where would you deliver? You deliver at this silo. At the bank, we actually have storage facilities, or you can close it and you can net settle it on a paper basis. Like, you need to know all of the nitty-gritty, the details of your product, okay? Because it's not a question of you asking somebody else, because you own the product. So as opposed to a salesperson that can say, okay, I can set up a meeting with a product specialist. As a deal maker, you are the product specialist. Maybe not necessarily, because, for example, for me, I was in the mining space. So I knew quite a fair bit about derivatives because of what I studied at university. But, you know, if you're a mining deal maker, maybe you rope somebody who's in the hedging team to talk about derivatives. But if you have a firm background there, it helps. No information is wasted. So, okay, next one. The ability to cross-sell and work in a multidisciplinary, multi-product space to deliver complex solutions to complex problems. Okay, this is very important. Again, just to reiterate the point that I just made, no information is wasted. So if you are in mining, but you have a background in derivatives, you will look at a client and you'll be able to cross-sell. It's like upselling, but basically, if I didn't have the derivative knowledge, I would just come to the client meeting and propose that we give the client this debt solution. But now that I know a little bit of hedging, I can then say to the client, you know, why don't you also look at this aspect? And maybe because you're lending in dollars, but your operations are in Chile, perhaps you can look at some sort of a cross-currency basis swap, because your operational costs are in peso, but your loan is in dollars. So because I understand how cross-currency basis swaps work, you give the client a more holistic solution to their problem. And then you can say as a bank, okay, we will execute the cross-currency basis swap and the loan with you. And it's upselling. Another word for it is cross-selling, because my division is maybe just in control of the loan. We just provide the loan. But there's another division that does the hedging. So we rope them in, and we're doing multidisciplinary work. So there's this product area, this product area. Maybe we rope in the people from the working capital department and say, we'll do your payroll, we'll handle your salaries, and you pay into this proceeds account, and or you get paid in this proceeds account, and here's the disbursement account. We'll handle all of these things for you. So you're getting different people involved, and that is cross-selling. Because you know a little bit about every single product area, the solution that you propose to the client is a lot more comprehensive and well thought through if you have the multidisciplinary approach. Financial modeling is a very important skill to have, but it depends where you are. Don't only stop at the model. Also keep on trying to push yourself to understand the bigger picture. I know this is a mistake that I made in my career, that I was too focused for the first few years in just trying to get the numbers right. And once I got the numbers right, that was the end of my work. Whereas I feel that if I had just ventured a little bit more into bigger picture from an earlier stage, I would have progressed a lot faster in my career. And I give you the same advice. If you are typically coming in as a junior deal maker, you will probably be more on the analytical side, meaning that you'll focus heavily on the models. There's nothing wrong with that. Even senior deal makers and my mentors in the beginning were senior deal makers, but still running with the modeling. But they got very efficient at the modeling such that they could do it very quickly and focus on the main tasks of sales and structuring. Okay. And as well, the legal documentation is also quite an important phase of the deal as well. But I'd say coming up with an idea and coming up with a structure. And if you have the model, and if you're close to the model, you as a senior deal maker or the deal maker that's designated to this deal, you can come up with a lot of iterations, and you don't have to rope in somebody else and wait for them to say, can you please run the scenario and see if we give them this amount of debt, if it's within their debt capacity and if it solves their problem. You can just do it yourself. So you can run through your ideas and fail a lot quicker. Come up with 10 ideas, maybe 3 work. Whereas if you're depending on somebody else to run the model, maybe you have to wait for them to run the scenario, and you have to be cognizant and sensitive to their workload as well. You can't probably do as much. So financial modeling, key, very important skill to have. Writing, very important. You will be writing a lot of term sheets. You will be writing a lot of sales copy, or not really copy, let's just say sales presentations. You'll be doing a lot of those verbal communication, so these go hand in hand. You'll be doing a lot of PowerPoint as a front office deal maker. So your ability to communicate clearly, to put your presentations in a format that you can send to the client and then give a verbal presentation as well. Something as small as communicating via email and answering client questions via email. To be clear and concise in your emails, a very important skill. Attention to detail and big picture thinking. Okay, this seems like a bit of a contradiction, but you need both. You need to be comfortable working with potentially bulky Excel models and not making mistakes, not making too many of them, and also to take an eagle-eye view of things. So this is also a very important skill to have. And probably the most important skill, especially for deals that you are running, which will tend to happen towards the middle portion to latter portion of your career. If it's your deal, you need to project manage. That is your job description as a deal maker. You are actually a project manager, and we will see how that works shortly. Okay. How do deal makers do their job? Okay, so this is a basic checklist of what your day-to-day entails. Okay. First, step 1. Listen to your client's objectives and pain points. You are in front of a client. You want to ask them pointed questions, but you want them to do most of the talking. They will tell you what their problems are. Don't invent problems for them. Okay. So the better you solve their problems, maybe you'd need to clarify, and maybe through some brainstorming, you realize that the client is only addressing a symptom. Let's, for instance, say a client is complaining about the risk of interest rates going up, and their solution to that is an interest rate swap, where they're going to fix the interest rate going forward. And then you tell them, maybe that's not such a good approach. Maybe refinancing your total capital structure is a better approach, because maybe you have revolving credit facilities where if you just took out a corporate bond, you could save up to 200 basis points on your debt, and you wouldn't have to incur the margin costs of an interest rate swap. So maybe the problem is not really, the client's problem is they view interest rates going up as a problem. But maybe if you look at it more holistically, you look at their entire capital structure and say, okay, it does solve the problem that you communicated to us, but there's an overarching theme here that your entire balance sheet is just not purpose fit. for what you want to achieve in the next 5 years, you can accomplish what you want to accomplish, and it'll solve 10 other problems if you just refinance your current facilities. So listening to the client's objectives and coming up with intelligent solutions to them. But sometimes you do have to dig a little bit deeper and maybe convince the client that maybe they're only looking at a small aspect of the problem when there's a multidisciplinary approach that solves their problem even better than what they initially thought would solve it. Okay. So step one, listen to the client's objectives and pain points. Next, you analyze the client's historical financials in the context of what their objectives and their pain points are. Now, the only way that you'd know whether or not the client's proposed solution is viable is if you look at their historical performance. If the client wants to do an interest rate swap, and you look at their current debt facilities, and you look at their current balance sheet, and you look at how much they do in revenue, you can tell the client, well, if you want to do an interest rate swap or even a hedge on your top line revenue, for the amount of revenue that you earn, doing a hedge is very inefficient because it would actually end up costing you X, Y, Z. So any benefits that you gain from just hedging this line item completely would be offset by the cost of doing so. But there's a different approach. There's a cheaper approach if you go this route. So you'd only know that if you know the client inside and out. So you analyze their historical financials. You also analyze their historical financial performance and future forecasts in context with their objectives, and you come up with a solution. Okay. So then you do this very iteratively. After you've come up with a solution, you analyze the historical results again and the forecasts to see if your solution actually works or if it's actually feasible. Can it work? So it's iterative. Look at the history, propose a solution. Does the solution fit in with their forecasts and their history? Nope, try a different solution. And you keep doing that until you find a solution that sticks. In other words, you come up with multiple iterations and possible solutions. And then you present the best solutions to the client. Okay. In this presentation that we do, in this section, we do 3 solutions. Okay, you could either hedge using forward contracts, put options, or zero cost collar. And we outline what each of these solutions are, the benefits and the considerations thereof. And that's basically what you'd be doing at a meeting or pitch to the client. You'd give them a whole host of solutions that solve their problem, but also certain considerations or drawbacks of each solution. And then you'd conclude, you'd choose the best solution, you'd recommend one solution, but you've also given them alternatives to look at. You'd then draft a term sheet to summarize the solution. As we saw earlier, the term sheet would just be a summary of the transaction, basically, just a high-level summary. And then you would negotiate that term sheet with the client. Once the term sheet is negotiated and agreed, you'd prepare a credit or an investment thesis or credit or investment paper. You would then present that to your credit committee or your board. And if that gets approved, then you move to the next step of negotiating legal documentation and other logistical, operational, or administrative steps that need to be put in place to close the deal. Remember, as a deal maker, you're the project manager, so you have to manage a whole host of different parties. You have to manage the central balance sheet guys to make sure that you're offering this $1 billion loan to the client, that you actually have $1 billion on the balance sheet to advance to the client. It might sound trivial, but your balance sheet management team might need 2 weeks notice if you have a big transaction like that. So you need to keep them in the loop, and you need to educate them as well that this facility will be drawn down on day one in full. They need to make adequate provisions. If it's a country like my own country where we have exchange control regulations, this is especially where you have to keep a lot of people in the loop, because they then need to get permission to pay over dollars, especially if it's in a country, we call them common monetary area countries, they need to get approval from the Reserve Bank to, let's say, I'm a South African, to lend dollars to Namibia, you need approval because it's a common monetary area, what we call common monetary area, just for example. So as a deal maker, you need to project the exchange control team, the tax and VAT team, the credit analysis team, and you need to manage the client's expectations. You'd need to manage the lawyers, and you'd need to make sure that everybody dovetails so that everybody's ready to push the go button, but then you get an email from exchange control saying that government approval is still pending and it'll take 2 weeks. Wow, and the client is expecting the money tomorrow. Very important for you to monitor that such that you started the exchange control process at least a month before, just to make sure that you've got some leeway in case something goes wrong there. And we will see that shortly. Let's move on to the credit role. So as a credit analyst, we call these middle office roles. You're not necessarily client facing, but you are doing a lot of numerical and financial analysis in order to unlock the deal. You are basically, you are what's the right word to use? You can't sidestep the credit process. So it's a process that's a key milestone in getting the deal done. Okay, so a very important part of the process, and it's a dedicated resource that is just involved in analyzing the risk of the transaction. Because without this, then the bank would make a lot of mistakes. But it's the credit analyst's role to pick up on the credit risk of the client. And credit risk is just the risk of a client defaulting on a loan. Okay, so you can either look at individual clients as a credit analyst, or you can look at the entire bank's portfolio, and we'll come to that in the next section. So credit analysts assess the default risk, and this is summarized by a rating scale. Your rating scale just talk about the PD, or probability of default, and you start with prime risk, which has the lowest probability of default, and then you move down, and as you move down, the probability that this client will fail to make capital and interest payments increases. Okay, so the higher the risk, the lower the client's rating, and then you get sub-investment grade, often referred to as junk. Although that's a bit of a misnomer. You can get a very healthy corporate who's still in the double B bracket. It just means that they're not investment grade, but still very healthy corporates. So it's a little bit of a misnomer to call everything here junk. It's better to call it like non or sub-investment grade. And a lot of the counters that you deal with in the mid-tier mining space will be sub-investment grade, and they will be organizations that are significant and well-run, not necessarily outside of the bank's risk mandate and not junk companies. So it's a little bit of a misnomer. So a lot of what you deal with in the mid-tier mining space will be in this double B bracket. So you have the probability of default and the loss given default, LGD. Loss given default is it's a percentage that summarizes if this client can no longer make capital and interest payments, and they have to be, for instance, liquidated or go for any other remedial action. How much of your debt will you need to take a haircut on? Or in other words, how much loss will you suffer on this transaction if this client was to default? Okay, so for an unsecured loan, meaning that you have no collateral, your loss given default can be estimated through historical history in your bank. And let's say, for instance, it's 40%. So if you loaned a company $1 billion and it was unsecured, you had no collateral, and this company defaulted, you would expect to lose 40% of your loan. So you liquidate the assets, it goes for auction, and you only get back $600 million out of your $1 billion that you loaned in the beginning. And your LGD is therefore $400 million, or 40% if your LGD is 40%. So you combine your probability of default and your loss given default, and that tells you how risky the deal is in essence. And as I promised, now we're touching on this point of capital that the bank would need to hold against a deal. And this would be determined by your central credit department. So the amount of capital that you need to hold is seen as an expense for the bank. And the more risky a deal is, the more capital the bank has to hold against that deal. So central credit analysts take a portfolio view of the bank's asset book, and they set guidelines as to how much exposure the bank has appetite for in each rating bucket. We call them sometimes prudential limits per client. So in other words, if you have a bank that has got a lot of BB risk, your central credit team will tell you we're almost full up. We can't accept any more transactions in the BB bracket. So what you'd have to do then, if you want to do a deal very badly with a client in the BB bracket, you'd either have to sell off some of your existing BB exposure, insure some of your BB exposure, or you'd just have to not do the deal and focus on doing deals in maybe your upper tiers, your investment grade bracket. Just bear one thing in mind, that the lower you go on the rating scale, the more money you could potentially make in terms of interest margin. So the lower the rating, the higher the margin. That's why the BB bracket is oftentimes a sweet spot, because these are still well-run entities, but you can charge them quite generous rates of interest on the debt, as opposed to an investment grade company where you can't really charge them that high a margin because they're such low risk and because everybody wants their business. So there's a lot of competition in that space. So it drives down profitability in this upper tier space. So just going back to this portfolio wide, if your balance sheet management team says we're almost full up on investment grade, you guys can write more riskier business because our portfolio is very well balanced. Then maybe if you've got a deal that's a BB plus deal, you can hold the full amount of that deal. If it's $1 billion transaction, you as a bank can take the full $1 billion onto your balance sheet. You don't have to share that risk with another bank. Okay. And here we just see the Basel II and Basel III framework, and that just touches on basically, depending on what the rating of the client is, you would assign a weight to, let's say, the loan that you provide to that client, and you have a $1 billion transaction, for example, and you would assign a weight of 50% of that $1 billion. So in other words, the weighted amount of that loan would be $500 million if it was in the BBB bucket. And then you'd need to hold a certain percentage of that risk-weighted assets on your balance sheet. So two things to observe: the higher the risk, the higher the weighting, sometimes even above 100%. And that means that you have to hold more in capital on your balance sheet. Okay, so basically what that means is if a bank has a certain amount of assets, okay, remember, using a very simplistic view, an asset on a bank's balance sheet is a loan that the bank has provided to a company, for instance. So the bank has lent $1 billion to this company. It's an asset for the bank, okay, because that company owes us money and this company will pay us interest and capital. So it's an asset for us. Now, we can't just give this company $1 billion. We need to give them $1 billion, but we also need to hold some money in our account. More formally, we have to hold certain amounts in reserves with the central bank, okay, to make sure that if this client falls over and defaults and doesn't pay us back, okay, that we don't go bankrupt, because we've got certain money across our entire portfolio that covers us such that if 10 of our clients default, the bank still has enough money to stomach that loss. Okay, so that's what capital is. It's that amount of money that you'd probably put on deposit with a reserve bank just as a safety margin, as a safety buffer. And unfortunately, that amount of money sitting with a reserve bank is not as profitable as the amount of money that is with other clients generating income as assets. So the bank sees that capital that you have to hold and set aside, it sees it as an opportunity cost, because that money could be out there in the market, but we have to keep it just in case something bad happens. And where we keep it is with assets that are typically very safe and don't give us as a bank a high rate of return. So it's an opportunity cost, and we view it as a cost, basically. So that is just an overview of what capital is. So if you're in a credit role, the job skills that you'd need is the ability to process large amounts of information and sort through what is relevant and what is irrelevant. So you've got a company prospectus, 100 pages, okay, and they're telling you about corporate social responsibility and how many kindergartens that they built and how many nurseries that they built as well. But they're also telling you that they've got an environmental liability of $100 million that is outstanding. Okay. In a credit paper, I wouldn't put both sets of information in there. I'd sift through what is relevant and what is irrelevant. Okay. If there's a potential claim, somebody's got a potential claim because the mine is located on an ancient burial ground. Okay. Although it is a very serious issue from a cultural perspective, and although it is an issue that perhaps ethically, depending on where you're sitting as a stakeholder in the bank, what are the chances of that leading to a material loss for this mining company? If the claim is frivolous and it cannot be proven that this is an ancient burial ground, for instance, or if the damages would be something like $500,000, and the company would rectify that, apologize, send out a statement to the media, do a lot of damage control, and make the situation right, then it's not worth spending 3 pages on that. Maybe it's worth spending 3 pages on what they intend to do to manage their reputational damage for encroaching on that burial ground, which is something that we've seen. Actually, there was a case this year of an Australian mining company that did do that, and they got into very big trouble. So just with a pinch of salt, that sometimes these issues that seem innocuous can actually cause a material damage to the operations of a firm. But anyway, the point still remains, as a credit analyst, your job is to sift through what is relevant and what might be just noise. Okay. So the ability to communicate complex business and product ideas in very practical, easy to understand terms. You have to communicate all the risks associated with this deal to your investment or your credit committee. Okay, and it needs to be concise. Your credit paper can't go on forever and a day, because your job is to summarize all of the risks into key risks that make the committee decide, is it a go or is it a no-go decision on this deal. You need strong numerical skills. You will be working closely with the financial history and with the financial model as well. You need to understand if the debt capacity proposed is legitimate. Can this company take this debt that you're proposing? Is it a good investment if you're proposing a principal investments transaction? You need good written and verbal communication skills. You will be writing investment papers, so you need to be very good at writing clearly and concisely. And you also will be presenting these investment papers to a committee, basically highlighting all the risks. That's when in a credit committee, the deal makers typically would just explain what they want to do in the deal, and then they would hand it over to the credit analyst, who would then go through section by section. These are the material risks. This is how the deal team has attempted to mitigate those risks. We then hand it over for the committee to decide whether the deal makers have done an adequate job of mitigating that risk, or do the deal makers have to go back to the client and try and negotiate harder, claw back some of the things that they perhaps conceded in the negotiation process. And so you would have to chair those discussions as a credit analyst. And the secret to a good investment credit paper, as we touched on in episode 1. So check out episode 1. Towards the end, you'll see every part of the video has been timestamped. Just check out the part on tips for writing a good credit paper. Context and opportunity cost, very important. You have to put every number in your credit paper in context. You can't just assume, it's enough to say top line revenue grew by 6%. You have to say, okay, then what did the industry average do? Okay, that's putting it in context. And then opportunity cost. Should we do this deal, or are there better deals to do with the same amount of risk but higher profit? Okay, in other words, maybe this is not the optimal deal to do at this level of risk. And so this is how you write very good credit and investment papers. I encourage you to check out that video. Capital and credit charges, sourcing liquidity. As promised, we will now touch on this section in greater detail. Okay, so maximizing margin. So basically, as a deal maker, especially in the debt side, you are lending money to a client, and the client is paying you interest. Okay, but what are your costs? Your costs are the capital charges that you have to set aside. You have to set aside capital against that loan that you will advance to the client. So how do you maximize your profitability as a deal maker? You can maximize your margin. In other words, you can charge the client as high an interest rate as possible. Unfortunately, this is not always doable, or fortunately, because whatever interest you charge needs to be commercial. It needs to be market related. And if you charge usurious or obscenely high rates of interest, you could land in trouble with regulators, or a competitor will just come and steal your lunch. You could have played the game ethically, but you chose not to. And in the long run, you can lose. Okay, so you can either maximize your margin by charging as much interest as possible. What are the ethical or good business practices in order to charge as much interest as possible? There are ways to do it ethically. You offer more value-added services to your client. Okay, you do what's called arranging and underwriting. I think the next slide will show an example, or the next 2 slides will show an example of what we mean by that. But basically, don't just offer the client money. You say, in addition to this money, if we're going to underwrite the facility, you need $1 billion. Okay, you ordinarily would need to raise $1 billion with 3 banks. What we will do is we will raise the full $1 billion for you. You don't have to worry about negotiating with 3 other banks. Okay, you just negotiate with us. We will organize the full $1 billion with you, so it takes the stress. You can save 1/3 of the time in negotiating with 3 different banks. You just negotiate with us one-to-one. We underwrite that transaction. And then what we then do is, after we have given you the $1 billion, you can then focus on your operations. We will then source 2 other banks, and we will negotiate with these 2 other banks. It's not your problem. We will do it. And we will give you the $1 billion at the interest rate that you want. So that's a value-added service, and a client would be prepared to pay you a lot more than if you would just say, okay, you want to raise $1 billion. Okay, we'll put our hands up for 333 million of that. Okay. And then the client would have to come to terms with you and 2 other banks. And those negotiations, because every bank has their individual peculiarities, it would take the client a lot more time to do so. You could also offer to arrange for the client, in which case you don't necessarily underwrite, but you are involved in the structuring of the deal, and then you bring in other banks. So you're offering the client more value add because you've got more of a service that you're providing for the client. So they would offer you an upfront fee for either underwriting or arranging the facility. And that's one way to maximize your margin. Another way is to participate across the risk spectrum of the client's capital structure. We touched on this in last week's webinar, that's episode 2, where you can have a company with a capital structure that has senior debt and it's got subordinated debt. Okay, so if you're providing senior debt to this company and you like the risk, and the senior debt is only giving you a margin of 3% over LIBOR, why not also come in on the mezzanine debt? If the mezzanine debt offers you a margin of 8% over LIBOR, you like the risk of this company. You believe that the company's probability of default is low enough that it warrants senior debt and mezzanine debt of a certain amount. Why not improve your weighted average return on the client by investing both in the senior debt and in the mezzanine debt? Okay, makes sense, doesn't it? So you can improve your profitability margins by participating across the risk spectrum of the client, depending on what your bank's mandate is. Maybe your bank doesn't like mezzanine debt, which is more risky and is generally what we call subordinated. It gets paid after senior debt gets paid. Maybe your bank doesn't like that subordinated risk and you can't do mezzanine. But you can still maximize margin by offering more value-added services. You can minimize your credit charges. You can do this by de-risking the deal as much as possible. You can get a sponsor guarantee, which we touch on in the mining finance course. Completion guarantees as well, we touch on. You can do hedging. You can as well investigate the track record of the management team. If the company has a good management team, this is also seen as a very good risk mitigation tool, and you might get some benefit of good management team when you're deciding your rating for the company. A good management team can make the difference between a company that's in the double B bracket. But if you can motivate that, no, the actual management team has done this 20 million times before, then you could bump up your company from the double B bracket to the triple B bracket based on a good management team with adequate experience. A comprehensive security package. Remember, we said a loss given default for unsecured facility, in other words, for no collateral, let's say is 40%. So you're going to lose 40% of the amount that you lent if you don't have any collateral. What happens if you do have a collateral package? Okay, and we touch on this extensively as well in the mining finance course. If you have a collateral package, what you can then do is you can say, you haven't paid me, I'm going to attach your assets and I'm going to get the first bite of the cherry because I am a senior secured lender. Okay, so now I own your trucks, I now own your plant, I now own all of your office equipment, and whatever we sell it for, I'm going to get the first bite of that cherry or first bite of the apple. And then only after I've been paid in full will other creditors get paid after me. And if you're secured, it can bring your LGD, depending on the asset cover. So you've lent $1 billion to a firm that's worth $3 billion in terms of book value of assets. Okay, you have adequate asset cover there. So you can then motivate for very low loss given default. Maybe your LGD goes down to 10%. So it's highly unlikely for you to lose significantly. Maybe you will lose something because you know, there will be costs to the liquidation process, and you will not get the book value of the assets when you do a liquidation. You're going to get a fire sale value, which is typically lower than the actual value of the assets, or what they would be, the market value would be under ordinary circumstances. But your LGD would come down significantly, which would lower your credit charges. Okay, and you can take commercial risk insurance or political risk insurance. That means the insurance company will give you a payout if the company defaults on the loan for commercial reasons or for political reasons, which we touched on last week in last week's webinar. You can just have a listen to that one if you want a bit more detail. You can also minimize your capital and liquidity costs. This just goes down to the structure of the actual debt that you provide to the client. If you provide an amortizing facility, okay, a facility that's repayable in installments over time, what you'll find is that facility has a lower duration, or on average, duration just measures a lot of things, but at the face of it, it's the weighted average value of the cash flows associated with the transaction. So you take the weighted average of all the capital and interest that you'll receive on the transaction. And let's say you have a facility that's got a duration of 3 years. It means that even if the facility itself, the loan is a 5-year loan, at the 3-year mark, you break even. Whatever you have advanced to the client, you get back after 3 years. Now it's capital and interest, okay, is the primary driver there. So you make your money back after 3 years, and whatever remains there is just extra. So that's a very loose way of looking at duration. So a facility that amortizes or steps down over time has a shorter duration. In other words, you get your money back faster than a facility that's repayable in a big bullet at the end. And because you get your money back a lot faster, the credit risk associated with such facilities is lower. Okay. So you need to look out for facilities that have a lower duration, and that will save you in credit charges. Okay. You can also look at how your deposits and your capital is sourced from your bank. If your bank has a strong balance sheet, you will actually save money when you're trying to raise deposits and raise money in the bond markets as well. You need to comply with any regulations. We have, depending how you pronounce it, BAL or Basel regulations as well. If you comply with those regulations very well, then your capital and liquidity costs go down. And you can also lend in very liquid currencies such as the US dollar. A loan provided in US dollar versus Zambian kwacha, it would cost you a lot less to lend in dollars than in Zambian kwacha, because you're assuming country risk when you lend in kwacha. So these are just certain structural tools that will help you to reduce your costs as a bank or as a deal maker, and then increase your profitability. So these are typically the levers that you have to play with. You can either maximize the deal margin, or you can minimize your credit and your capital and liquidity costs. So as promised, let's look at the asset and liability side. So if you're in central credit, you would be concerned with managing the bank's balance sheet. And let's see how this works in practice. So if you look at the top, we have got a bank here. And this bank has got assets and it's got liabilities. Let's start with the liabilities. People come and they deposit money with this bank. The bank also goes out in the bond markets and raises funds by issuing bonds in the market. Okay. Now, money is flowing into this bank, but the bank needs to pay that money back in the future. So this is a liability for the bank. Okay. Next, the bank also has borrowed money from other banks in the market, and these are called interbank loans, also a liability. Last but not least, the bank has issued shares in the market. Okay, the bank is probably a listed entity, which most likely it is. So it's issued shares, and in return, shareholders have paid the bank. So you have your liability, which are the deposits, the bonds, and the interbank loans, and you have your equity, which was sourced from shareholders. On the asset side, what does the bank do with all of this money? Okay. The bank loans this money out to potential borrowers. So then money goes out of the bank. But remember, the bank can't loan everything out. It has to keep aside some reserves. Now, those reserves that it keeps aside are governed by the Reserve Bank, and it keeps those reserves with the central bank, or the Reserve Bank. So looking at this example here, you have a bank with a certain reserve requirement. And what happens if the bank holds too few reserves? In other words, it holds less than the legal requirement. The first thing that banks do is they then need to borrow reserves from other banks. Okay, so this bank has issued out loans, and now this bank needs to top up its reserves. So it'll then borrow money from another bank. As we can see, this bank has got a surplus of reserves. It'll borrow money from this bank, okay, leading to an increase in the assets, but it'll also lead to an increase in liabilities because now this bank owes the other bank money that it has borrowed to top up its reserves. Okay, so this is how the interbank market works. And if you are in central credit, you are primarily concerned with making sure that the bank complies with these reserve requirements. Okay. So yeah, the last thing that we're going to look at is asset and liability management from a distribution and a syndication point of view. Okay, so Basel III encourages banks to reduce their balance sheets. So as we saw earlier, a bank will increase the assets of its balance sheet by lending money out into the market. Basel III wants to reduce the balance sheets of each bank. In other words, it would prefer each of these banks to have lower balance or smaller balance sheets, meaning that the banks would need to share risks in the economy amongst themselves. This would lead to more diversification. Okay. So the prudential limits that we saw earlier, remember we were talking about our central credit team saying that maybe the company has got too much sub-investment grade risk. So they would say to the company, you can't take the full $1 billion exposure on your next sub-investment grade client because we're already full up there. You need to write more business that is investment grade. Okay? So this is another thing that constrains deal makers. So deal makers write a deal in the double B bracket, but central credit tells them you can't keep the full $1 billion. Okay? So deal makers would then need to spread some of that risk or sell it off in the secondary market. So they'd still do the deal. Maybe they'd underwrite it, but they would then sell off the deal in the secondary market, or they'd need to get insurance on half of that portion, the portion that goes over the prudential limit. Okay. And also, banks need to balance the requirements of Basel and internal capital models by writing loans and sharing risk. So distribution, you sell to the secondary market. You've written business, but it exceeds the limit of what you can take in that risk bracket. So you need to sell down in order to comply with whatever your central credit team tells you is your prudential limit for that risk bucket. Okay. So you can either sell to the secondary market, which is called distribution, or when you are writing that loan, you write that loan telling the client, primarily, we're going to do this deal with 3 banks. So those 3 banks are in the primary transaction. It's not necessarily selling to those banks in the secondary transaction, secondary market. Secondary market means the transaction is already closed and you're just selling that exposure. They're not involved in the original structuring of the deal. Whereas for a syndication, those banks will probably have some say in the original structuring of that deal. But those banks will come in as co-funders. And your last lever that you can pull is the insurance lever. And that's typically in the form of commercial risk insurance. So tips to ensure a loan can be sold down or syndicated easily. The loan has to have healthy fees and margins. Funding the deal must be done in a liquid currency. As I mentioned before, it's a lot easier to sell a deal in the secondary market if it's in a liquid currency like US dollar versus a deal in Chilean peso. Not many banks can take Chilean peso country risk, or not many banks play in the Chilean space. But if it's a US dollar loan, it's a lot easier to sell it to a whole host of international banks. And the borrower must have a compelling and profitable business case. If it's a good client, you'll find it easier to spread that risk out in the market. And your debt needs to have strong transferability provisions. Okay, so let's just drill deeper into how the distribution and syndication process would work. Let's look at the example of an underwrite. Okay, so you would start off with a bank that lends $1 billion to a borrower. Okay. So the bank promises this bank the underwrite and says, we will give you the $1 billion that you need, and you only have to negotiate with us. We underwrite that transaction. Now, the bank can communicate to the borrower that we can't actually hold the full billion on our balance sheet. It's not big enough. So we have to find other banks to come into this loan syndicate after this transaction is closed. But it's okay. We'll worry about negotiating the terms and conditions and pricing with them. You just pay us a certain fee and a certain margin, and we'll get you your $1 billion, and you can just walk away and do what you do, focus on your operations. And then it'll be our risk if we can't get that billion out into the market and reduce our balance sheet by sharing the risk in the broader market. Okay, it's our risk as a bank. So what the underwriter will then do is it will then identify secondary lenders, and it will sell the deal to them. The secondary lenders will say, okay, that's a good deal. We'll come into that transaction with you, alongside you. And maybe now there are 5 banks in this transaction, $1 billion transaction. So each bank now gets $200 million. So the underwriter has sold off $800 million of its exposure to other lenders in the market. Now, what the underwriter does is the underwriter won't necessarily pay these secondary lenders the full fee and the full margin that it received from the borrower. Let's say the underwriter received a 2% fee for the transaction and a margin of, let's say, 5% over LIBOR. What it'll do, it'll keep some of the fee for itself. So instead of paying these secondary lenders a 2% fee like it received, it will say, I did all the hard work, I did all the negotiation with the client. I'm only going to pay you secondary lenders 1% instead of the 2%. It won't probably even tell the secondary lenders that it got a 2% fee. It will just say, this is the deal, take it or leave it, 1% fee. And it probably won't even offer, if it can get away with it, it won't probably even offer the secondary lenders the 5% over LIBOR that it received. It'll say, take it or leave it, the deal is 450 basis points over LIBOR at a 1% upfront fee. And if the secondary lenders are happy, they take a slightly lower fee and margin, and the underwriter skims the rest as a profit for itself. Okay? And that's typically how an underwriting would work. And as we saw earlier, this is one of the ways that a bank can increase the margin that it charges to a client in a very ethical way, because the borrower is happy. It only needed to negotiate with one bank. The secondary lenders are happy. They're getting a good asset with good returns. And the underwriter is very happy because it's skimming off some of the fee and some of the margin because of the additional work. It did additional work by taking on this $1 billion risk for the short term. Because what if it didn't manage to find these secondary lenders? It would be stuck with an exposure that's larger than it initially intended on holding. So to get compensated for that additional work and additional risk, it skimmed off fee and margin. Okay. And the last thing that I'm just going to close off on was the point earlier about one of the first points I made about just being a deal maker and being a project manager. And I'm just going to close off on this just to bring everything together, because that was the purpose of this webinar, was just to talk about the different roles in an investment bank and how they all dovetail, how they all come together in order to get the deal over the line, and to see what party does what role in bringing the transaction to fruition. And it's typically the senior deal maker who's charged with project managing the deal. So if you're looking at a mining project financing, you prepare the term sheets and you've got a Gantt chart that tells you how many months that would take. You appoint the mandated lead arranger, agree the final term sheet that's in the client's hands, appoint legal counsel, deal with independent technical experts, construction contractors, you do your site visits, credit approval process, financial model is agreed, finalized legal documentation, security for full conditions precedent, and then finally financial close and drawdown. So if you look at all of these steps, you have various parties that need to be coordinated. Your independent technical experts. You need to make sure that they don't delay the process after month 3, because you need that work to be done in month 3 before you can do the site visit. And you need the site visits concluded before you can begin the credit approval process. So it's quite evident that as a deal maker, you are coordinating various work streams and making sure that everybody is on time in order to make sure that you close the deal in month 8, because you might find a very, very pivotal part of this transaction, such as closing the legal documentations, can hold up a whole bunch of processes that need that to be in place first. So project management is a huge part of being a deal maker. Okay. And the last thing that we'll close off with is just the deal timeline, just to see how everybody fits together. Okay. So you build a client relationship, you probe for opportunity. This is your sales team. You pitch your ideas to the client. This is the sales team along with the deal makers. The client approves. Now you negotiate the term sheet. Now this is in the deal maker's hands. Next, the credit investment analysis and credit or investment board approval. This is now in the deal team and the credit analyst team's hands. The legal documentation. This is where the deal makers sit down with the lawyers and they negotiate the deal. The conditions precedent. Now, this is where we mentioned that last point about the facility agent. Your facility agent is effectively just it's an administrative function that is taken on by the bank. So they are responsible with registering any collateral and security. They're responsible with actually disbursing the funds to the borrower and receiving capital and interest from the borrower and then dispersing it to other lenders. And so they're just in charge of the administrative function. Basically, they're the enabler that actually enables the deal to actually process once it's been closed. So they also tick off conditions precedent, which are terms and conditions that need to be met before any money could be advanced to a client. So you have your conditions precedent there. And finally, the deal is closed. And then remember what we said at the beginning, the fortune is in the follow-up. So then you'd start the process all over again. You already have the client on board. You probe for additional opportunities. You pitch to the client again, negotiate term sheets, you upsell the client, and you begin this process, and it's a circular process. Okay. I hope you enjoyed the webinar. If you'd like notifications of when new webinars will be posted, please subscribe to the YouTube channel below. And also, if you'd like to post questions, I often answer student questions on subsequent webinars. Please join the LinkedIn group. Also, I'll leave a link to that below. And that LinkedIn group is called Tauro Group Education. So please join the LinkedIn group. And I'll also leave a link to my website where you can also browse through some of my Udemy short courses and my flagship offerings, where I also offer one-on-one coaching along with the theoretical knowledge on mining finance, treasury management, and a whole host of other courses on financial modeling as well. I hope you enjoyed this, and I look forward to seeing you on the next webinar. Take care.